topic which is very important when we finalize the account is depreciation on the fixed assets. Okay, these are the rates of depreciation. You have to note down these rates. Always furniture 10%, machinery 15%, vehicle 15%, computer 40%, office equipment 15%. Okay, so these are the rates of depreciation, but depreciation we are calculating at the end of financial year. Okay, now here, this is very important here. One note I have given here. Any asset which is purchased before, see, any asset, this note is very important here. Any asset which is purchased before 30th of September, we are calculating full depreciation. Full depreciation, these are the rates, okay? If any asset is purchased after 31st of September, this half the rate means what? This is right now 10%, it will be 5%. 15%, it will be 7.5, like half the rate of this. If any asset is purchased after 30th of September. So I'll go to the tally and I'll pass some transactions here before explaining you. So assume that I have purchased some asset. When we purchase the asset, we pass the payment entry. First, we pass the journal entry for the bill. Say debit what computer. Suppose I'll put the date here. 1st of April. Suppose I purchase some computer on 1st of April. Okay, say debit what computer account. This is not purchased to sell it, but it is for office use. So debit will be computer account, say about 25,000. If there is a GST on the bill, you have to put what? Debit input CGST, SGST. I will not put that. Say credit what? RT. I purchased that from Jameson computer. Okay. Sundry creditor. Done. Okay. Suppose I purchase another computer, one more computer in June, say 1st of June. I'll put June. Say again what? Computer account debit. I'll put say 40,000 here. I purchase one more computer from Jameson computer. Okay. Again in say I purchase one more computer in say November. In November, say as a computer account debit under say about 35,000, say Jameson Enterprises. Okay. Similarly, suppose I purchase some furniture on say 1st of say May, say furniture account debit. It's already there. If the ledger is not there, you have to create it. 12,000 debit what say Shahu Marketing. You give any name to the party. I'll just pass the bills. Okay, similarly, suppose again I purchase some furniture in 1st of what say December, say furniture account debit, say about worth of 10,000, say Shahu Marketing. Okay. Similarly, I purchase one car, say car account debit, say in say 1st of say December only. 1st of December I purchase one car account debit. It's not there. Car account debit under what? Fixed assets worth of 5 lakh. And credit what? Say I'll just pass the payment directly because there is no party for here. So car account debit, I purchase a credit what? State Bank of India. Okay. So these are the assets what we have purchased. Even suppose we purchase one machinery also. So I'll pass the journal entry for the machinery. I purchase a machinery, say machinery account debit under what? Indirect fixed assets. Under fixed assets, I'm not entering GST part. Say machinery of say 5 lakh and credit what? Say from which company? Say XYZ company. Sundry creditors. So these are the entries I have already passed in account during the financial year. At the end of the financial year, we prepare what? Depreciation. We calculate depreciation. To calculate depreciation, let us go to the balance sheet now. I'll go to the balance sheet. Detail about the balance sheet. I'll click on detail here. See, these are the fixed assets. What we have? Car, we have computer, we have furniture, machinery, and why that Shahu Marketing is here. I'll just press Control Enter here. He is actually sundry creditor, not fixed assets. Okay. So there is a car, computer, furniture, and machinery. These are the assets what we have. So I'll go to the Excel and calculate the depreciation on the assets. Okay. Let us take the depreciation on car. I'll just put here. You have to prepare this depreciation also. This report you have to prepare in Excel. This is assets. First is what we'll put car. Okay. Okay. And here you have to make say the column before SEPT September. I'll put first opening balance before September, after September, depreciation, and the return down value. So these are the columns you have to prepare for depreciation. First, let us calculate the depreciation of car. So I'll go to the car, go to the balance sheet here, detail about the balance sheet, put the period here, 1st of April to 31st of March. Period is very important. 1st of April, 31st of March. Okay, open the car account, enter. See the car here. Car is purchased in December. Worth of what? 5 lakh. There is no value on top. So the car is purchased in December worth of 5 lakh. Okay. Now as per this TDS, car is a vehicle. Okay, there is a 15% GST. This one is a depreciation is there on the car, 15% GST depreciation. So important thing is, see, to calculate depreciation, first go to the balance sheet, fixed asset. I want to calculate the depreciation on car. Press enter on car here. See, the car is purchased in December. That is what? After September. This is purchased after September. When any asset is purchased after September, we have to calculate what? Full half depreciation, half the rate. Okay. Now, what is the rate of depreciation here? What is the rate of depreciation on vehicle? 15%. Okay. Car value is what? 5 lakh. Okay. So I will calculate what? 7.5% on the half the rate. So depreciation is 37,500. Okay. So I'll put it here only in this table. Car opening balance is 0 because here as per this there is no opening balances here, 0. There is no opening balances. Before purchase there is no before September nothing is there. Before September this is also 0. After September is what? 5 lakh. Depreciation on this directly half the rate into 7.5%. Half the rate. Return down value will be what? Opening balance plus purchases before value plus after value minus depreciation is a return down value. Okay. Second, now I'll calculate the computer now. See the computer. This is the September month of September. This is purchased before and this is purchased what? After. Whatever is purchased before, that is total. You calculate the total of this. It becomes what? 65,000. On 65,000, I'll write it here on my table. Say computer. I will calculate now computer. Before value, opening balance is not there. So I will not use the opening balance. After, before, this is 0. This before value is 65,000. After value is what? 35,000. Okay. So depreciation I will calculate here. On 65,000, I will calculate. See the on computer depreciation is 40%. Okay. On computer depreciation 40%. So on before value, I will calculate 40%. And on after value, I will calculate what? 20%, half the rate. So total depreciation becomes 26 plus 7, that is what? 33,000. So total depreciation I'll type here 33,000. This I'll remove. Okay. Understood how to do. Before value full percentage, after value after September half the rate. So total depreciation is what? The return down value becomes opening balance plus before value plus after value minus depreciation is return down value. So next one, I'll go to the tally. Next one we have furniture. Furniture September. Again in September there is what? 27,000 is before value and 10,000 after value. So furniture. furniture. I'll just increase the size so that you can see it more better. So on furniture, there is opening balance is not there. Okay. So if there is opening balance here also, you have to put the opening balance. There is opening balance here on top. Remember, opening balance means previous year data. Okay, you have to put that there. Before value, I'll just put it here just to explain you. Before value is what? 27,000. Then after value is 10,000. Okay. So depreciation on furniture, on this is what furniture, depreciation on furniture is 15%, sorry 10%. So what I'll do now, how you will find it out. So before value and opening balance you add, and on this you find out 10%. Okay, and whatever after value is there, that is 10,000, you find out what? 5%, that is half the rate. So total depreciation becomes this plus this, that is 4,200. 4,200, that's total depreciation. Okay, so this opening balance and before value you add and calculate full depreciation on this, and after September only half the rate. Okay, yeah, so this is written down value is, so this plus this minus this depreciation. Okay, now what is left now? Machinery, that is purchased in December, that is after September, that is 5 lakh. Machinery, okay, this is 0, this is 0, after is 5 lakh. On machinery there is 15% depreciation. On machinery there is a 15% depreciation, machinery 15% depreciation. So I will do here 15% depreciation after is what? 15 minutes, 7.5% depreciation. So written down value is this minus this. Okay. Okay. Now suppose any asset, now for example, suppose I purchase, I will just pass one more entry. Suppose I brought one more vehicle, say suppose I purchase some, say, Xerox machine. Say directly I'll pass the payment for that, you can pass it. Xerox machine. Okay, under what? Fixed assets, say about 10,000, say about 50,000. Okay, and say cash, I paid by cash. Okay, and during the year, say that machinery is that Xerox machine is sold, it becomes old and we sold that and we received money, so I'll pass a receipt for that. Say Xerox machine is sold, okay, for what? 30,000 we have sold it. Okay, and say debit what? Say we have received the cash, it is sold for 30,000. Okay, when I go to the machinery here, Xerox machine, see the 20,000, when I press enter here, okay, see here it shows we bought the Xerox machine, and just I'll change the date of the receipt here, say 1st of March we sold that. Okay, now see here Xerox machine is purchase of 50,000, that is credited, means sold of 30,000. There is no, right now at present there is no Xerox machine for the in the business. Remember, whatever Xerox machine was there, we have already sold that. That means that machinery, that Xerox machine is not there with us. In this case, see, to find out the depreciation, first of all, that asset should be there in the business, but that Xerox machine is not there in the business, it is sold. Okay, in this case, we have to find out whether it is a profit or a loss here. So we have purchased for 50,000, we sold it for 30,000. 20,000 is a loss on the sale of this asset. So I will not find out the depreciation in case of Xerox machine, but in account I'll pass the entry on 31st of March, journal entry on 31st of March, loss on sale of asset under indirect expenses, remember. Okay, that is of 30,000 is a loss, 20,000 is a loss, and credit what? Xerox machine. That's it. Okay, so this is the way you have to prepare the depreciation report. Okay, and after preparing the depreciation report, we have to pass a journal entry for depreciation. This depreciation, total depreciation is how much? This is the total depreciation. 1,12,200 is the total depreciation. Pass the journal entry on 31st of March. Debit depreciation under indirect expenses. Okay, 1,12,200, 1,12,200. Credit all the assets, that is a car. On car there is a depreciation of what? 37,500. On second is a computer. Credit what? Computer. On computer there is 33,000 depreciation. Credit then furniture. Furniture we have 4,200 depreciation. And then machinery we have 37,500. That's it. So depreciation as on 31st of March, this entry you have to pass.